Hello, everybody. Alton Moore here from Evolution Tax and Legal, back with you again. Today, I'm bringing you a third installment of a four-part series on the relief provisions passed underneath the CARES Act. As you guys may know by now, the CARES Act was passed in response to the economic fallout of COVID-19. There's so many relief provisions contained therein. We're breaking this series down into 4 different videos. We're going to break it up by topics such as tax due date relief, the various grants and stimulus payments that the government has passed, relief as it pertains specifically to businesses, investors, and professionals alike. And then we're going to top it off where we talk about relief as it pertains to the use of retirement plan funds. So in this video specifically, we're going to talk about relief as it pertains to businesses, investors, and professionals. So let's jump right in. So before we get too deep in the weeds, I wanted to go over what we're going to talk about in this video. We're going to talk about 5 of the most relevant relief provisions to businesses, investors, and professionals alike. So we're going to start with a discussion on the forbearance of federally backed mortgages. We're going to move on to a discussion of changes to net operating losses. We're going to move on then to increases of bonus depreciation, how to utilize that. And then we're going to talk about, increases of interest expense limitation and the removal of excess business losses limitations. We'll cover each one of these in turn. So for our first topic of discussion today, we're going to talk about the temporary forbearance on federally backed loans. What this provision allows you to do is go to your servicer and request a temporary stop on the payment of a federally backed loan. I've noticed this is a provision that's not widely known, but can be very useful for those who've been negatively impacted by COVID. So first thing you need to know is, how do you qualify? Well, you have to show you have experienced a financial hardship as a result of COVID. Second, what you also need to know is that there's different treatment between residential owners and multifamily owners. The forbearance periods are different, but what's very specific about that is the amount of dwelling units on a parcel of property. You're considered to be an owner of a multifamily property if you have 5 or more dwelling units on a single parcel. The next thing you need to know about this provision is the actual length of forbearance. So how long can you put a stop to the payment of your federally backed loan? Well, as I mentioned, the treatment varies between being a residential owner and a multifamily owner. For residential owners, you can request a forbearance for up to 180 days. Once that period's over, you could actually make a second request for another 180-day period. That's almost a full year. Now, for multifamily owners, it's not nearly as favorable. For multifamily owners, you can only request an initial forbearance for 30 days. After that, you have the ability to request 2 more 30-day periods, but then you're cut off. So there's some important notes I want you to keep in mind with this provision. First off, if you're a residential owner, please note that no penalties, interest, or fees will accrue during your period of forbearance. But note that that same treatment isn't afforded to multifamily owners. Multifamily owners actually can accrue penalties and interest for the period that they don't continue to pay their loan. Second, what you need to know is that you actually have until December 31st of this year to apply for forbearance. So if you think you qualify or you think it could help improve your financial position, keep that date in mind because it's approaching quickly. Next up are changes to bonus depreciation. So to really give you the full context of why this is important, we have to go back to 2017 when the Tax Cuts and Jobs Act was originally passed. As part of that law, lawmakers intended to give improvements to commercial properties bonus depreciation treatment so that it wouldn't have to be capitalized and depreciated over the life of the property. Now, there was a very, very technical error in the writing of the law that actually disallowed this treatment. And Congress, they didn't get around to fixing it until COVID came into the picture. So how did the CARES Act fix this law? Well, they actually went back and are now allowing certain improvements to commercial properties to be immediately expensed as opposed to being capitalized and depreciated over the life of the property. And in fact, they made this change retroactively. So not only does it apply to the 2019 and 2020 tax years, it applies to 2018. So you may be asking why this change is important. Well, it now allows those making improvements to commercial properties to expense the full cost of improvements as opposed to capitalizing them and recuperating those costs over a 39-year period. To give you a quick example on this, imagine that there's a developer or tenant who makes $150,000 of improvements to a commercial property that they own or are leasing. Underneath the old law, they could only recuperate about $4,000 of that expense as a tax deduction over the next 39 years. Now, because of the changes to the CARES Act, they could actually go back to 2018, file an amended return, take as a full expense the $150,000 of improvements, and thereby create or increase a refund that they would have otherwise been entitled to, putting liquidity in their pocket to manage with the economic fallout from COVID-19. Next up, we're going to talk about net operating losses and changes and how to utilize them moving forward. So to once again give you that full context of what we're talking about here, well, I have to once again harken back to 2017, before the Tax Cuts and Jobs Act and the changes made by it thereafter. So before Tax Cuts and Jobs Act of 2017, if a company incurred a net operating losses, so they had more expenses than income, they could carry that loss back 2 years, or they could carry it forward 20 years, thereby offsetting that loss against other potential taxable income they had. Now, the 2017 Tax Cuts and Jobs Act rolls around and changes that. No longer could you carry that net operating loss back against potentially taxable income you had in prior years. And in fact, you could only carry it forward, but they did make one improvement there. They allowed it on an indefinite basis. However, it didn't come out without a cost. They limited the use of that net operating loss, or an NOL, to 80% of the total net operating loss incurred in that year. So you could never use 100% at any given time, almost making it impossible to utilize it all at once. So the CARES Act rolled around and changed this for the 18, 19, and 2020 tax years. It changed it by allowing you to take a net operating loss that you incurred in 18, 19, or 20 and carry it back 5 years preceding the year in which it was actually incurred. Additionally, they got rid of that 80% limitation and are allowing you to use 100% of that loss so long as it was incurred in 18, 19, or 20. So why is this important? Well, it's allowing you to take a loss that you incurred in one of the current years and carry it back to another year in which you had taxable income, and thereby clearing a refund to put liquidity back in your pocket to deal with the economic impact of COVID-19. How are you actually going to utilize this change to net operating losses? Well, you have one of two choices. You can either file an amended return or file a tentative claim for a refund. The difference between the two is the timing to prepare it and the timing it takes the IRS to process it and actually give you your refund. An amended return takes much longer to prepare by your accountant or attorney. Additionally, it takes a much longer time to process that amendment by the IRS and send you your refund. On the other hand, a tentative claim for a refund is much easier and simply prepared by your accountant or attorney and is much faster processed by the IRS, putting that refund in your pocket on a faster basis. So if you need liquidity now, you should file a tentative claim for a refund. So I want to leave you with some important notes on the changes to the net operating loss rule, specifically with tentative claims for a refund. If you need to get a tentative claim for a refund for an NOL arising out of 2018 tax year, you only have until June 30th to get that filed. For an NOL arising out of 2019 tax year, you have until December 31st of this year to get that filed. And finally, for an NOL arising out of 2020, you have till the end of 2021 to file that tentative claim for a refund. Next up, we're going to cover temporary increases to the business interest expense limitation. To give you the full context on this, I really got to go back to the 2017 Tax Cuts and Jobs Act once again. As part of that tax act, the government implemented a new limitation on the use of business interest expenses. Specifically, they limited the amount of interest expense you could take as deduction to 30% of an accounting term known as EBITDA, which is earnings before interest, taxes, depreciation, and amortization, which is a type of net income number which they base this limitation upon. Why that was important is because it negatively affected industries that are heavily reliant on the use of leverage or loans or lending. One that you could probably think of off the top of your head is real estate. If you are a real estate owner or investor, you will see that you normally use leverage or lending to purchase that property. Now, if they're limiting your ability to deduct interest expense from your operations, it's going to increase your taxable income and thereby increase the amount of tax that you're going to owe to the government. So the CARES Act changed this provision by increasing that 30% limitation to 50%. So now you can deduct interest up to 50% of your EBITDA, earnings before interest, taxes, depreciation, and amortization. Once again, this was designed to decrease your taxable income and thereby decrease the amount of taxes you would eventually owe to the government. Keep in mind that this only applies to the 2019 and 2020 tax year. It does not work retroactively, and it stops after the 2020 tax year. So next on our list, we're going to discuss the temporary removal of the limitation on excess business losses. Once again, I'm going to have to harken back to the Tax Cuts and Jobs Act of 2017 to give you some context of what's going on here. As part of that act, the government imposed a new limitation on the use of losses from pass-through entities. Specifically, they only allow a person to offset losses from a pass-through entity up to $250,000 for those filing single and $500,000 for those filing joint against other income they would have derived in a given year. So let's use a quick example here to flesh this out. Let's say you have a businessman. In business one, he earns $500,000 in a given year. Let's say in that same year, he reinvests all $500,000 into a new business named Business 2. In the first year of Business 2, he loses $300,000. Economically, he has a net income of $200,000. However, for tax purposes and due to this limitation, he can only use $250,000 of that $300,000 loss as a deduction against his $500,000 of income he earned from Business 1, thereby requiring him to report and pay tax on $250,000 as opposed to the $200,000 of economic income he actually earned in that given year. The CARES Act temporarily removed this limitation for the 2018, 2019, and 2020 tax years. That means if you are subject to these excess business loss limitations in the 2018 tax year, you can go back, file an amended return, and increase or create a refund you would have otherwise been entitled to had that provision not in place. Additionally, you do not have to worry about this limitation for the 2019 and 2020 tax years. Guys, that was a ton of information we just went over. I'm assuming you have questions. So if you do, go to evolutiontaxlegal.com to book a consultation, get on a phone call with one of our team members to help get those questions answered. Also, if you're interested in learning more about the other relief provisions that have been passed underneath the CARES Act, go check out our other 3 videos on the CARES Act, which you can find on YouTube at Evolution Tax and Legal or directly on our website at evolutiontaxlegal.com. Once again, I want to thank you for your time, and we hope to see you soon.